What's going on, everybody? It's Stas here. So in this video, we're going to be talking about the lazy way that you can get to $1 million in the stock market. And let me tell you guys, right off the bat, this is not flashy. It's not the coolest thing to talk about. Quite honestly, it's boring and it takes time, right? So if you're a person out there that wants to start out at a young age, middle age, whatever, and you want to just funnel money into the stock market, not think about it, kind of like a set it and forget it type thing, and watch it grow over time and have a passive approach, this is for you, right? Because you're considered the quote-unquote lazy investor, somebody that doesn't want to really be hands-on with their investing, right? So this is for you. We're going to talk about that today, what you can do over time, and we'll break down some numbers that can get you to millionaire status in the stock market. So if you guys find value, hit the like button, make sure to subscribe, check out the StrapSmart Discord chat and the StrapSmart Facebook group. Those are free of charge to join, link down below, and you could also get 3 free stocks from WeBull valued up to $1,600. All you have to do is deposit $100, and that is how you get your free stocks. So let's get into it, guys, starting off with index fund investing. And this is getting very broad in the stock market, right? We have a couple indexes. We have the Russell 2000. That's a small cap index, right? Smaller companies in there. We have the S&P 500, which are the 500 largest publicly traded U.S. companies. We have the Dow Jones Industrial Average, right? A bunch of long-term blue chip companies in there. And we have the NASDAQ, right? The NASDAQ has a bunch of high-growth companies, bunch of tech companies, and so forth, right? So those are the indexes, and a very broad way to invest in the stock market and be diversified within the stock market is investing in these indexes, right? You can invest in something like ticker symbol VOO. This is an ETF here that tracks the S&P 500. Again, the 500 largest publicly traded companies. These are companies that have, technology company, or an index that has technology companies, right? Think of Apple, Microsoft. There's also healthcare like Johnson & Johnson, Procter & Gamble, right? You also have companies like Coca-Cola, Pepsi. So all across the board is what you're getting in the S&P 500 and investing in something like VOO, right? Another one here is SPY. This is also known as SPY, right? This is another S&P 500 ETF, very similar to VOO. It gives you exposure to a bunch of companies in, you guessed it, the S&P 500. So let me show you guys here on Safari, and we'll get into this in a second here, but this ETF here, which is VEA. But let me show you. These ETFs, such as SPY and VOO, they do have a bit of an expense ratio, and you'll notice this with a bunch of ETFs out there. That is what you have to pay to have the ETF managed, right, or to have it ran in a way, right? So 0.09% is what you pay for SPY to pretty much hold it. And that's really a very small amount, considering some mutual funds out there charge 1% to 2% to have the fund managed, right? And you also have a dividend yield of 1.7% here and a year-to-date total return of about 6.6% on SPY. And VOO is very similar, the Vanguard S&P 500 ETF. This one's a 0.03% expense ratio, so much lower, and a dividend yield of about 1.7%. So this is a great way to get your toes in to the S&P 500, right? And you could also do something like VTI, which is the total stock market index. This has a bunch of holdings out there. It has an expense ratio of 0.03%, has a yield of 1.7%, a dividend yield, and a total daily year-to-date return of about 7.4%. Another total stock market index fund is going to be VTSAX, right? Ticker symbol VTSAX. This is another Vanguard one with an expense ratio. Let's take a look here of Let's see. Actually, no, this is the wrong one. Actually, no, this is the right one. But you guys can see it doesn't show expense ratio here, but actually, no, it does. It's 0.04%, and the yield dividend is 1.7%. So these are a couple of ways that you can get extreme diversification out there, right? And if you're looking to do maybe something like a 3-fund portfolio, this is something that a lot of people talk about out there in terms of a lazy way to approach the stock market and a more diversified approach to the stock market. The 3-fund portfolio has 3 different funds. One of them is U.S. equities, which we just talked about. A lot of funds that have U.S. equities, VOO, SPY, VTI, and VTSAC. So you'll have one of those funds in the 3-fund be U.S. equities. The second fund is going to be international equities, guys, because you don't want exposure only in the U.S. You want some exposure outside of the U.S., like Europe, Asia, a bunch of countries out there, right? And one that I like for that, you guys saw it earlier. It was kind of I showed it a bit too early in the video. It was VEA, guys. Vanguard FTSE Developed Markets ETF. This is an ETF an exchange traded fund that has companies outside of the U.S., right? So every holding in this ETF, let me show you guys back on Yahoo Finance, every holding on this ETF is from outside of the U.S., right? And that's how it's purposely built for people out there that want some exposure from those different companies, right? So year to date, it hasn't been doing too well. It's down about 5%, but the dividend yield is 2.4%, and the expense ratio is 0.05%. And take a look here at the holdings, guys. If we zoom down a bit, you see it's a bunch of different companies, right? You have Nestle, depending on how you want to pronounce that. You have Samsung, Novartis, SAP, you have Toyota, right? A bunch of foreign companies. So this is a way that you can get international equities by doing something like VEA, and there's a bunch of other ones. And for full disclosure, I personally own VEA in one of my portfolios. So the first fund is U.S. equities, like we just said before. Second fund is international equities. And the third fund is going to be a bond fund, right? And for me, guys, I'm not the biggest bond guy. There's a bunch of bond funds from Vanguard. I mean, you guys can look through them. I'm not the biggest bond guy, but if you're younger, I personally, and this is not financial advice, but I personally think if you're a younger person, you shouldn't really mess with bonds because there's not much upside, right? The younger you are, you should be more in international equities, U.S. equities for the growth because you have time on your side. And as you're a young person, time on your side is what you need in the stock market to succeed because long term, the market, hey, it goes up 7-8% per year. So the way that you can structure this 3-fund portfolio, again, U.S. equities, international equities, and bonds, you can be more heavy in U.S. equities and international equities as you're younger. Let's say you're in your 20s to 30s. You can have more weight there and little to no bonds. But as you get older, let's say 40s, 50s, maybe you start selling off some equities and going more into bonds. So let's say, for example, you're 80% in equities, 50% in international or U.S., and let's say 30% international, which makes 80. You could be in 20% in bonds when you're, in your 40s, right? For example, and let's say you get into your 60s. Let's say you went from 80-20 equities bonds. Let's say you go 50-50 or something like that. And then you go into your 70s, you go to, 20% equities, 80% bonds, or 30% equity, 70% bonds. At the end of the day, guys, it all depends on your risk tolerance. And again, this is the lazy way to approach things, and it's a passive way because let's say you do this 3-fund portfolio, you start out in your 20s, 30s, you're averaging money in, and we'll take a look at a compound interest calculator here in a second. But let's say you're starting out young, you're averaging in, and as time goes on, all you really have to do is I mean, yeah, you have to manage it, maybe once or twice a year, but all you have to do is kind of rebalance things to your risk tolerance. So as the years go on, again, maybe trim some of those equities and go and rotate into bonds. That's kind of the only thing you really have to do at this point, as a lot of these ETFs are managed and you're not really in need of doing much work. Again, hence the title, which is the lazy way to get to $1 million, right? And there's a bunch of other ETFs you can look at depending on what you guys want, right? Let's say you want to create your own little 3-fund portfolio and you want to do some high dividend yield ETFs. You can do that, right? These are ETFs that have a lot of holdings in them. VYM is one that I like. VYM is the Vanguard High Dividend Yield ETF. This one yields about 3.5%, right? And it hasn't been doing too well this year, down about 10%, but the expense ratio is 0.06%. So this could be one that you might want to add. And another one that I like personally, guys, and again, this is all my opinion, is NOBL. This is the ProShares S&P 500 Dividend Aristocrats ETF. And you may be asking yourself, what the heck's a Dividend Aristocrat? It's a company that's raised the dividend year after year for 25 plus years, and they've paid a dividend for 25 plus years. And this ETF has all of those companies, right? So if a company fails to pay a dividend or raise it, it gets kicked off the list, right? So if you guys want quality dividend companies, this could be one for you. Expense ratio is 0.35%, so a little bit more pricey on the expense ratio side, but the yield's 2.2%, and again, it's built of upon a lot of quality companies. And if you want to have some growth ETFs, some that I personally like and own are the ARK ETFs. And I don't know if I'm going to get slack for that by a more traditional investor, but for me, guys, I like these innovative ETFs that invest in the future companies of our world, right? ARK, ARKK. This one, it does have a bit of a higher expense ratio, but if you guys look deeper into the history of these ETFs, they've performed so well, it's unbelievable. They have returns in the 30s to 40% for the past couple of years. It's crazy. So the 0.75% expense ratio, which is a bit higher, and this is a more actively managed ETF, it's justified at the end of the day, right? I mean, take a look. Year-to-date return is almost 100%, guys. So if you're getting 100% return in a year, 0.75% of an expense ratio is not breaking the bank. And the fact that this is actively managed, meaning they're in and out trading and managing the ETF for you, this is perfect for the lazy investor because you can buy in, they do the work, you pay them 0.75%, and you just come back in 10 years. And I'm not going to say definitely, but likely you're going to be a lot higher. Let's just put it that way. So ARKK is one I like. ARKQ is another one from ARK. This one is the Autonomous Technology ETF. The other one's the Innovation ETF. And this one also has 0.75%. So keep an eye on this one, guys, and the Qs as well. QQQ, this one's more for the NASDAQ, right? So these are a bunch of growth-oriented. We went over some high dividend ETFs and the 3-fund portfolio. And again, you can just tailor this the way you want it and then set it and forget it and then not actively manage it, but check in on it once or twice a year, tweak things, and you're off to millions, right? That's literally how it goes. And it kind of does depend on your time horizon. And of course, the earlier you start, the better. If you're starting at 20, you're in a golden spot, and we'll take a look at some numbers here very quickly. And a great way to do this tax-free, guys, another tip for you all, is open up a Roth IRA, especially if you're young, right? If you're 18, the best thing you can do is open up a Roth IRA. You're able to add $6,000 per year into this, and when you're 56 and a half, I believe, is the year you can take it out and use the profits. You don't have to pay taxes. That's the beauty of it, right? So you're taking post-tax income when you're young and you're not really making much money, as a lot of young kids are not making money. So you take that money, you put it in, right? You invest it, and then over time, and when you're older, you're supposed to maybe, a lot of people say have a higher tax rate, you get the tax break from doing the Roth, right? If that makes any sense. And you guys know, for those of you guys that know the Roth, you know what I mean exactly, right? So the current principle, let's say you have $10,000 when you're 18, which a lot of people don't, so let's change that. Let's say you have $5,000 and then you do $6,000 per year. Let's say you grow it for, let's say, 40 years and an 8%, which is the average return. You're going to have $1.8 million, right? You're going to have $1.7 million. And let's say you maybe are, let's say, 30 years old, 40 years old, right? And you're starting a bit later, and you have a job that pays higher income. And that's another thing here, guys. The income you make is really determines how fast you get to the million. So let's say you're able to put $2,000 a month in the stock market, which is a lot more than the $6,000 annual addition. Let's say you can do $24,000 a year into the market, which is a lot, let's be honest, for the average American out there. And let's say you're starting out with 5,000 with 24,000 added every year. You're not going to need that long. You're not going to need 40 years to get to the million. You might need 20 years, right? Yeah, you might need 20 years. So if you're starting at 30 or 40 and you think you're late to the game, you're not. You still have time, and you can work out these numbers for yourself. And let's say you don't have $2,000 a month. Let's say you have $1,000 a month. You can do $12,000 per year, and let's say you grow it at 30 years, and let's say you get a 10% return. Let's say you beat the market's historical average. You'll still be well above a millionaire. Let's just put it that way. You'll be a 2.2 millionaire. So I really advise you guys to come onto a compound interest calculator and work with the numbers, and you'll be amazed as to how much money is out there for you and how you could actually lazily make millions by just diligently. You can be lazy, but you have to be diligent at the same time. Diligently adding money every month, bi-weekly, week, however it works for you. But yeah, that's pretty much it for the video, guys. A lazy way to get to a million. So if you all found value, hit the like button for me. Make sure to subscribe to the channel, and don't forget to claim 3 free stocks. If you're watching this before October 30th, you're lucky, because that promotion runs out October 30th. So get your 3 free stocks. All you have to do is deposit $100, and you get your 3 free stocks. I also get 3 free stocks since it is an affiliate link, and I do appreciate you guys for using it. So I'll catch you all in the next video. Thanks for watching. As always, peace out.